Hello, dear students and scholars. Now we are bringing ASC 320 together. This final application lesson is not only about remembering the rules, it is about using them in written answers, case analysis, interview responses, and framework comparisons. We will work through three short answers, one long answer, one case study, four interview questions, international financial reporting standards comparison, and statutory accounting principles comparison. The memory line for this video is very practical. Classify first, measure second, and locate the gain or loss third. If you can follow that order calmly, ASC 320 becomes much easier. If you skip the order, the answer may still sound confident, but it may land in the wrong financial statement. Accounting has a gentle way of punishing shortcuts, usually with a reconciliation that refuses to agree. Short answer 1 asks about classification logic. A company buys a 2026 corporate bond and it has documented positive intent and financial ability to hold the bond until maturity. The most appropriate classification is held to maturity or HTM. The reason is that ASC 320 requires both positive intent and ability to hold until the contractual maturity date. Mentioning only intent is not enough for full credit. The measurement basis is amortized cost, not fair value. Unrealized holding gains and losses are not recognized for HTM securities, so they do not flow through earnings and they do not flow through other comprehensive income or OCI. A strong written answer should clearly say HTM classification, amortized cost measurement, and no recognition of unrealized holding gains or losses. That is the complete structure. Short answer 2 compares trading and available for sale or AFS. Both categories are reported at fair value on the balance sheet, but the landing zone for unrealized gains and losses is different. Trading securities are held with a near term profit objective, so unrealized gains and losses flow directly to earnings each reporting period. There is no accumulated other comprehensive income or AOCI component for trading securities. AFS securities also use fair value, but unrealized gains and losses generally go to OCI and accumulate in AOCI within equity until sale, impairment, or reclassification. The key difference is not fair value itself. The key difference is location. Trading says earnings now. AFS says OCI and AOCI for unrealized holding changes until the event becomes realized. Short answer 3 focuses on an AFS sale and AOCI reclassification. If an AFS bond has a cumulative unrealized gain in AOCI before sale, that AOCI balance does not stay in equity after the bond is sold. First, the AFS bond is removed at its carrying fair value. Second, cash proceeds are recorded. Third, any difference between proceeds and carrying fair value is recognized as an additional gain or loss in earnings. Fourth, the cumulative unrealized gain previously parked in AOCI is reclassified out of equity and into earnings. This creates the full realized earnings effect. A complete answer must explicitly state that AOCI is reclassified into earnings upon sale. Leaving a realized gain parked in equity is not permitted. Once the bond is sold, the parking ticket has expired. Now we move to the long answer task. Apex Treasury acquires four debt instruments in 2026. Bond A has documented positive intent and confirmed financial ability to hold until its 2031 maturity date. Bond B was purchased specifically to profit from anticipated near term price movements. Bond C is held for liquidity management, is not designated for trading, and does not have the ability to be held to maturity. Note D is a structured note with index linked cash flows, and embedded derivative features may require separate analysis. Your task is to classify each instrument, state the measurement basis, and explain where unrealized gains or losses are reported. In a written answer, do not jump to one word labels only. The examiner wants category, measurement, and reporting location for each instrument. Here is the model answer framework for Apex Treasury. Bond A is HTM because management has documented intent and financial ability to hold to maturity. Its measurement basis is amortized cost, and unrealized holding changes are not recognized in earnings or OCI. Bond B is trading because it was purchased for near term price movement profit. It is measured at fair value, and unrealized gains and losses flow through earnings each period. Bond C is AFS because it is neither HTM nor trading. It is measured at fair value, with unrealized changes reported in OCI and accumulated in AOCI. Note D requires boundary analysis. Start with the debt security host, but check ASC 815 for possible embedded derivative bifurcation. If bifurcation applies, the embedded derivative is measured at fair value through earnings. Now we enter the practical case study. Meridian Company holds an AFS corporate bond at year end 2027. The amortized cost is $1 million. Current fair value is $960,000. The present value of expected cash flows is $985,000. Meridian does not intend to sell the bond and is not likely to be required to sell before recovery. That condition is important because it allows us to separate the credit loss component from the non credit fair value decline instead of writing the entire security down through earnings. The required analysis is to split the $40,000 total fair value shortfall into credit and non credit components, prepare the journal entries, and reconcile the balance sheet amount. The case analysis has three steps. First, calculate the total fair value shortfall. Amortized cost of $1 million minus fair value of $960,000 equals $40,000. Second, calculate the credit loss component. Amortized cost of $1 million minus present value of expected cash flows of $985,000 equals $15,000. That $15,000 represents expected credit deterioration. Third, calculate the non credit decline. Total shortfall of $40,000 minus credit loss of $15,000 equals $25,000. That $25,000 is attributed to market, interest rate, liquidity, or other non credit factors. The AFS credit loss allowance is capped by the fair value shortfall, and here the $15,000 credit loss is within that $40,000 ceiling. The reporting answer now becomes clear. Meridian recognizes credit loss expense and an allowance for credit losses of $15,000 in earnings. The entry is debit credit loss expense $15,000 and credit allowance for credit losses $15,000. The non credit decline of $25,000 is reported in OCI and AOCI, not earnings. The entry is debit unrealized holding loss in OCI $25,000 and credit fair value adjustment for AFS debt $25,000. The fair value reconciliation also balances amortized cost of $1 million, less credit loss allowance of $15,000, less non credit fair value adjustment of $25,000 equals reported fair value of $960,000. The core lesson is simple: credit loss and market decline are not the same thing. Now let us move to interview style questions. The first question is: what is the first question in ASC 320 analysis? A strong answer is the instrument a debt security within the scope of ASC 320? Before classifying as HTM, trading, or AFS, you must confirm the instrument qualifies as a debt security. Equity securities, loans, and derivatives may be governed by different standards. The second question is: What makes HTM classification difficult to maintain? The answer is that HTM requires both positive intent and financial ability to hold until maturity. Positive intent alone is insufficient. The entity must demonstrate financial capacity to hold without being forced to sell. Selling an HTM security early can also damage HTM credibility and may create serious classification consequences. The next interview questions require precise location language. Question 3 asks, where do trading unrealized gains and losses go? The answer is, trading securities are fair value through income, so unrealized gains and losses flow directly to earnings each reporting period. The purpose of trading is short term profit, so the income statement reflects market movements immediately. Question 4 asks, what is the key AFS credit loss trap? The answer is, do not treat every fair value decline as a credit loss. A fair value decline may come from interest rates, market liquidity, or other non credit factors. Only the portion attributable to expected credit deterioration is recognized in earnings through credit loss expense and allowance. The remaining non credit decline goes to OCI and AOCI. In interviews, location words matter: earnings, OCI, AOCI, and amortized cost. Now we compare with International Financial Reporting Standards, specifically IFRS 9. Under IFRS 9, classification starts with two tests: the business model for managing the financial asset and the contractual cash flow characteristics. The contractual cash flow test is called SPPI, which means solely payments of principal and interest. If the asset is held to collect contractual cash flows and passes SPPI, the result is amortized cost. If it is held both to collect and sell and SPPI passes, the result is fair value through other comprehensive income, or FVOCI. If another business model applies, or if SPPI fails, the result is fair value through profit or loss, or FVTPL. This SPPI test has no equivalent under ASC 320. The US GAAP and IFRS comparison is important because similar labels can mislead us. Under ASC 320, the starting point is management intent and financial ability to hold. Under IFRS 9, the starting point is business model and SPPI cash flow characteristics. US GAAP categories are HTM, trading, and AFS. IFRS categories are amortized cost, FVOCI, and FVTPL. Under ASC 320, there is no SPPI classification test. Under IFRS 9, SPPI is required for amortized cost and FVOCI. Embedded features also differ. Under US GAAP, embedded derivatives may require bifurcation under ASC 815. Under IFRS, the SPPI test is applied to the entire hybrid financial asset as one contract. So do not translate mechanically. Here are the IFRS exam traps. Trap 1. AFS under US GAAP is not automatically FVOCI under IFRS. FVOCI requires both the right business model and a passing SPPI test. Trap 2. HTM language does not replace the IFRS business model test. Under IFRS, amortized cost classification still requires SPPI to pass. Trap 3. Trading is not the only route to FVTPL under IFRS. A financial asset can reach FVTPL simply because SPPI fails even without a trading designation. Trap 4. Reclassification triggers differ. Under IFRS 9, a change in business model drives reclassification. Under ASC 320, specific HTM transfer and credibility rules are central. Compare the test, not only the category name. Now we shift to statutory accounting principles, or SAP. This comparison is mainly relevant for insurance company reporting and solvency focused statutory financial statements. SAP is governed by the National Association of Insurance Commissioners or NAIC and focuses on policyholder protection, regulatory surplus, admitted assets, and solvency. SSAP number 26 covers many bond investments. SSAP number 43 covers asset backed and mortgage backed securities. SSAP number 7 includes the Asset Valuation Reserve or AVR and Interest Maintenance Reserve or IMR. SSAP number 100 addresses fair value. NAIC credit designations can affect statutory carrying value and risk based capital. So, SAP is not simply ASC 320 with a different cover page, it has a different purpose. The SAP versus US GAAP comparison starts with reporting objective. US GAAP focuses on investor useful financial reporting, faithful representation, and external stakeholder decision making. SAP focuses on regulatory solvency and whether insurers can meet policyholder obligations. Under US GAAP, debt securities are analyzed through HTM, trading, and AFS categories based on management intent and ability. Under SAP, treatment depends on SSAP category assignment, NAIC credit quality designation, admitted asset status, and regulatory rules. Unrealized effects under US GAAP flow to earnings for trading or OCI and AOCI for AFS. Under SAP, unrealized effects may affect statutory surplus, AVR, IMR, or statutory carrying value depending on the applicable SSAP. Same bond, different framework, different result. The statutory reporting caution is very important. Do not force ASC 320 categories into a statutory reporting context. HTM, trading, and AFS are US GAAP constructs. They do not automatically become SAP categories. A bond classified as AFS under ASC 320 may receive different statutory treatment under the applicable SSAP. FASB guidance is not SAP unless adopted by the NAIC. Bond and asset backed security treatment depends on SSAP scope, such as SSAP number 26 or SSAP number 43. NAIC designation can affect carrying value or admitted asset status. AVR and IMR have no direct US GAAP equivalent. For statutory work, always check the applicable SSAP, NAIC designation, and any state prescribed or permitted practices. Let us close the ASC 320 series with the final checklist. First, confirm scope. Is the instrument a debt security within ASC 320? Second, classify as HTM, trading, or AFS based on intent and ability. Third, apply the correct measurement basis. Amortize cost for HTM, fair value for trading, and AFS. Fourth, route unrealized changes correctly. HTM not recognized, trading earnings, AFS OCI, and AOCI. Fifth, reclassify AOCI when an AFS security is sold. Sixth, separate credit loss from market movement in AFS impairment analysis. Seventh, apply IFRS and SAP comparisons with framework discipline. Dear students and scholars, ASC 320 is not about memorizing bond labels. It is about matching purpose, measurement, and reporting location. If this final ASC 320 lesson helped you, please like the video, subscribe to the channel, support the course, and share it with your colleagues who are learning US GAAP. I will see you in the next topic.